Live from Singapore, this is Insight with me, Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. The leader of South Korea's ruling party says President Yoon Suk-Yeol should be suspended from office, an abrupt shift in stance making it more likely an impeachment motion will pass. Meanwhile, in France, President Macron says he won't step down, promising to name a new prime minister soon. The parliamentary power broker Marine Le Pen is sounding conciliatory, telling Bloomberg exclusively that a revised budget is possible within weeks. We'll get reaction to all this with veteran investor Rajeev Mello, who also weighs in on the Fed's next move ahead of today's crucial U.S. jobs numbers. And India's Reserve Bank makes its rate decision later, balancing a surprise growth slowdown with persistent inflation. We'll get diverging views on whether they'll stick or twist from DBS Bank and OCBC. The leader of South Korea's ruling party says President Yoon Suk-Yeol should be suspended from duty quickly. It's a dramatic shift in stance that makes it more likely an impeachment motion will pass as early as tomorrow. Han Dong-hoon told Parliament that new evidence shows Yoon ordered the arrest of key politicians on Tuesday night as he declared martial law. Han says that keeping the president in office risks putting the country in danger. The change of heart may boost the opposition's confidence in pushing Yoon's impeachment, which is difficult without enough support from the ruling party. Democratic Party leader Lee Jae-myung told us earlier that ultimately the Korean people will decide Yoon's fate.
정치는 결국 궁극적으로 국민이 하게 되는데
Ultimately, politics is done by the people, and even if the result of the vote may go against the will of the people in the current situation, the vote result may change next time if individual members of the parliament are pressured heavily by public opinion. That's what I think.
Meanwhile, South Korea's finance ministry is playing down the impact of this week's bungled martial law decree on the economy and markets. Choi Sang-mok told us exclusively that fears about the country sliding into a recession next year are excessive.
최근에 비상계엄 조치가 이제 헌법과 법률에 따라서 신속히 해제됐기 때문에
The recent emergency measures were quickly lifted in accordance with the law, so I think the impact on the market was very limited. I'm not sure if that's the right answer to the question, but I think that South Korea is now operating a system that is better than the market safety measures. That system is working well, and as a result of its good performance, I think we are now finding some degree of market stability. In the future, if we face even more uncertainty, systems related to the market will work well, and we will be able to respond because we are ready. If there is any short-term volatility, the Bank of Korea and the financial authorities will work together to provide unlimited liquidity to the market. We will also take measures in this regard. Our basic direction has been to take various measures to stabilize the markets as much as possible. So once that was done, the Bank of Korea and the Financial Services Commission announced specific measures. In the future, if such volatility increases, we will take similar or more drastic measures when necessary.
I had a chance to sit down with the main opposition leader, Lee Jae-myung, very recently, and he mentioned how the instability that we're seeing in the markets right now is all to do with the administration, that once the president is removed, things would calm down, the foreign investors would come back. How do you respond to that?
글쎄 정치인이 어떤 말씀하신 거에 대해서 평가하는 건 맞지 않고요.
Well, it's not right for me to evaluate what he said. As far as I know, fundamentals of foreign investors' investment in Korea is affected by the fundamentals of our economy. As I mentioned earlier, because our various systems are working well, the impact on the economy has been very limited, and it's well managed. Even in the past, we have seen that the impact of non-economic factors was not a major concern for foreign investors. Rather, their sentiment has been swayed by fundamentals of our economy. The Korean government is stepping up its effort to strengthen the fundamentals of our economy. It is stepping up these efforts even further, and I believe this is a way to encourage foreign investors to invest in Korea a little more.
In the immediate aftermath of the martial law declaration, the lifting, and of course, potential impeachment proceedings, how are you planning to restore investor confidence, not only in the Korean markets, but in the Korean economy and fundamentals?
네, 아까 말씀드린 것처럼 이렇게 비경제적인 요인에 의한 어떤 충격이나 불확실성은 과거에
As I mentioned earlier, we have seen such shocks and uncertainties caused by non-economic factors in the past, but they were temporary and limited. We believe that the Korean system is working well in these areas, but the basic trust of foreign investors in the Korean economy is actually based on concerns that the Korean economy's potential growth rate and growth momentum are shrinking. So the Korean government is making efforts to increase the robustness of the Korean economy, innovation, and social mobility through the creation of a blueprint. And recently, due to uncertainties in global trade, we are making efforts to strengthen the competitiveness of some industries and others that are less competitive among the more traditional industries.
How are you preparing for the Trump administration?
지금 한 두 가지 차원에서 접근을 하고 있는데 하나는
We are approaching this from two different angles. One is through our efforts in trade diplomacy. The U.S.-Korea alliance is strong, so we are making similar efforts as we did when the Biden administration was inaugurated. This is to minimize this uncertainty that our companies and industries face by strengthening the negotiations between government in parallel with the inauguration of the new administration. The second is to take this as an opportunity to strengthen our competitiveness in key industries such as semiconductors and automobiles, as well as traditional industries such as petrochemicals and steel. We're preparing for crisis factors in each sector. We're also preparing measures to maximize the opportunities in areas where there are opportunities, and we are in communication with companies and industries.
Given the uncertainty about potential global tariffs, not to mention the political uncertainty in South Korea, what are the chances that we might fall into a recession next year?
지금 리세션은 얘기하셨는데 그 내년도에 경기 침체 우려가 있다는 말씀은 너무 과도한 우려라고 생각이 들고요.
I think it is too excessive to say that there is a risk of recession next year. Korea's growth rate next year, projected by the International Monetary Fund or the Bank of Korea, is at or near its potential level. Therefore, we will respond to uncertainties by combining appropriate macroeconomic and macro policies. We will also make efforts to strengthen policies that target more vulnerable groups.
South Korean Finance Minister Choi Sang-mok speaking exclusively to our very own Sherry-An. Now let's get more perspective on the Korean crisis. Rajeev Mello has been investing in global markets for more than 30 years. He's global macro portfolio manager at GAMA Asset Management. Rajeev, good to have you with us. I mean, it's not surprising that Korean officials are trying to allay concerns. We just heard from the officials saying that, you know what, the risk of a recession in 2025 pretty much overblown. But you know, this is an economy that narrowly escaped a recession last quarter.
No, it's really come at a very bad time for Korea. I mean, to have this domestic political upheaval, which is serious, just at the same time as the North is flexing its muscles, both in the alliance with Russia as well as with its sending of missiles. And then on top of that, a looming threat of tariffs and a tariff war with China, which will have an effect on Korea as well as a small open economy involved very much in the economic cycle, the global economic cycle. So very, very tough for Korea. I mean, of course, he'll put on a brave face, try to reassure us, but I think for emerging markets more generally and for Korea more specifically, it's going to be difficult.
So a recession in 2025 is a real possibility.
I think it's a possibility, yes.
It will force the hands of the BOK. We spoke to the central bank governor just about 2 days ago. He says, he doesn't see the need to cut rates again after the back-to-back cut. So he may just be forced to do another cut.
Yes, it's very difficult for central banks in emerging market countries. I mean, especially with the dollar being so strong, they don't want to see their currencies really weaken too much. If the CNY is going to depreciate more once tariffs are announced by the US, then it will drag down the won as well, which means that it'll be that tug of war between can we tolerate a weaker currency, but at the same time we need to support our economy. So that'll be the debate. But I think at the end they will cut.
The thing is, when you take a look at Korean assets, they've priced in a lot of the bad news. You take a look at the won, worst performing Asian currency this year to date, down 9%. We take a look at Korean stocks. They're among the worst performers in the world. I think the bottom 4. A lot has been priced in, but I'm not sure they've priced in how this crisis would eventually play out.
Well, we're going to have a period of uncertainty now with this impeachment proceedings, then afterwards wait for the elections. As investors, we hate uncertainty. And so during that time, nobody's going to jump in and really scoop up Korean assets. I think that'll be a problem. I mean, one saving grace for Korea is the yen. If the yen's sort of strengthening now or finished its big weakening, the won and the yen are closely tied and linked. So that'll help the won to some extent.
But the won is also closely tied to the yuan, which is not great news. I mean, given that China will definitely be in the crosshairs of Trump's policies and Trump's tariffs, is not good news for the won.
That's true. But on the Chinese yuan side, I think the issue is that it'll weaken, but it's a very controlled currency, and China has a lot of tools, so it wouldn't weaken all that much. I mean, already against its basket, it's actually quite strong. That's the official policy, but everybody looks at, and the leadership looks at the dollar. So they're a little bit more weakening, but in an environment of weakening currencies, I think that they have the tools to keep the Chinese yuan from weakening too much.
At the current rate, is the won already reflecting the weakness of the economy? Is it fairly valued now?
Well, I think with this uncertainty, it can weaken further. I agree with you, it's been one of the poor currencies, but there's no carry. It's got this uncertainty out there. It's part of the emerging market basket, even though it's really a DM country. But these types of events and the geopolitical in the immediate vicinity of Korea is tough and makes it tough to get that confidence to buy.
So still lots of risk for Korean assets. Rajeev hang tight. Rajeev Mello, GAMA Asset Management is sticking around. Now, concerns are growing in Japan about the political crisis in South Korea. Former Japanese Prime Minister Fumio Kishida has told Bloomberg the turmoil risks undermining progress in their bilateral relationship. Kishida, who left office in September, had formed a warm relationship with South Korean President Yoon Suk-Yeol over frequent meetings.
I think political stability in South Korea is important in order to move the Japan-Korea relationship forward. It seems like the turmoil is continuing right now, but I hope things stabilize as soon as possible. I would like to create an environment in which Japan and Korea can work together on economic, diplomatic, and security issues.
All right, coming up, India's central bank is widely expected to keep interest rates unchanged today. Economists from DBS and OCBC will be joining us with their diverging outlooks later this hour. Keep it here with us. This is Bloomberg.
C'est pourquoi je nommerai dans les prochains jours un Premier ministre.
This is why I will appoint a new Prime Minister in the coming days. I will ask them to form a government for the general interest, representing every political force within the spectrum of parties destined to govern, and that they could join or at least agree not to bring it down. The Prime Minister will consult and form a more effective government at your service. Its priority will be the budget.
That was French President Emmanuel Macron in a televised speech saying that the budget will be a priority for the next prime minister. Meanwhile, the architect of the current situation, Marine Le Pen, told us exclusively that a budget can be passed in a matter of weeks if the next prime minister is willing to narrow the deficit more slowly. She also says she sees no case for President Macron to resign under the current conditions.
To ask him to resign would mean to disturb our institutions. Once again, it's his decision. Now, if there is a political crisis, an institutional crisis, and if he can no longer dissolve the assembly, if reshuffle serves no purpose, then the French constitution only leaves one other option, which is his resignation. But that wouldn't be a drama either. There would be new presidential elections. General de Gaulle, you know, designed our institutions, and they are very solid. They are extremely solid. Everything's done to make sure that the life of the nation can carry on and not create disturbances that can't be dealt with. If he were to resign now, there would be new presidential elections and new legislative elections.
But are you worried about these crises then leading to severe market reactions?
No, because the reality is that what worries the markets is the economic situation in France. What worries the markets is the lack of perspective concerning reducing deficits. It's the absence of savings at the state level, the increase of taxation on companies that worries the markets. And in fact, you've seen the markets have remained extremely stable over the past few days since the announcement of the no-confidence vote, and even after the no-confidence vote. In reality, they had concerns at the moment of the dissolution in June. But for the moment, whether it's the spread between France and Germany, the rates, or the markets, but for the moment, whether it's the spread between France and Germany, the rates, or the markets, for the moment, everything is relatively calm. Because once again, they realize that anyway, there has to be at all cost another policy other than that envisaged by Mr. Barnier.
But the market is probably looking at the fact that the ECB is standing close and that there's a want from France of getting the deficit down pretty quickly.
Well, yes, but once again, there's a long way to go between wishes and reality. Mr. Barnier wanted to reduce the deficits. He's increased them by 12 billion. You see what I mean? So, once again, using a hammer to bash French people over the heads with taxes, when we're the country with the highest rate of taxation in Europe, is not the solution. But it's the only solution that French leaders have implemented for years. It doesn't work. Look at the situation we find ourselves in. So help companies, enable them to do business, reduce production tax, reduce the cost of energy, or at least reduce it to the same level as the cost of production in France. Those are things that will allow companies to develop and thus create employment.
Voilà, ça, ce sont des lignes qui vont permettre aux entreprises de se développer et donc de créer de l'emploi.
But Madame Le Pen, I mean, first of all, the Barnier actually proposal means that GDP would be the deficit of GDP would be 5% in 2025 compared to 6% this year. So it's going down.
Non, il augmentait de 12 milliards le déficit.
No, the deficit rose by 12 billion. The deficit rose by 12 billion. But you know, the head of Safran, which is a major company, has just given an interview. And what did the head of Safran say? He said Barnier's budget is a bad budget. So, in reality, the fact that it's last year's budget that's applied, however unfair it was socially, is actually rather good news for companies. There are a certain number of entrepreneurs in economic circles who are in fact pleased about the no-confidence motion because they consider Mr. Barnier's budget was worse than last year's budget, and that's saying something.
French National Rally leader Marine Le Pen speaking exclusively with Bloomberg Francine Lacroix in Paris. Now, a measure of French bond risk fell on Le Pen's comments to Bloomberg, raising hopes lawmakers will strike a deal on next year's budget sooner than expected. Rajeev Mello, Global Macro Portfolio Manager at GAMA Asset Management, is still with us. So there's some optimism, perhaps, but when you take a look at, the yields between the spread between, French and German bonds, I'm just wondering whether you see the spreads narrowing from here.
Yeah, I mean, they had a knee-jerk rally of 7 basis points. The spreads came in by 7 basis points after this resignation of the prime minister. But the road to a stable government which can implement this budget is very difficult. And it's very difficult to see how in this kind of chaos you really will have a reduction in spending, as Marine Le Pen just mentioned in an interview. So I think that'll keep investors on edge. International investors are going to hesitate before plunging back into France.
It is about confidence. You talked about international investors. We talked about how, Japan dumped French bonds. The question is really, will they come back? And why should they come back? What might that catalyst be?
Yeah, before France used to be part of the core. Germany, France, small spread, liquidity differences, but really a very solid part of Europe. But now with this uncertainty, with especially the persistent deficits and the growing ballooning debt, it's very difficult. On the one hand, Germany is criticized for being too austere, having a debt break and not spending enough, and France is overspending. Well, bond investors will rather reward the austere part of the market than the spendthrifts.
When the crisis started, people drew comparisons with, Greece, but, this is not a Greece-style crisis. People talk about how institutions are stronger, fundamentals are better. Is there reason to be buying into French assets right now?
Yes, it's not a Greek story. Greece was also a small part of the EU, whereas France is really at the heart and a very large economy in the Eurozone. So the situation doesn't have to deteriorate as badly as it did in Greece for it to have an impact on the rest of the Eurozone. On the other hand, France also and Europe suffers from what's happening in global trade. We don't know what the U.S. tariffs on French goods are going to be. France depends a lot on selling to China as well, all its luxury segments. It competes in the car industry, very difficult market right now. It's not particularly strong in EVs. So a lot of headwinds for France as well.
So what do you make of the confidence that we heard from Le Pen? She talked about how markets are stabilizing. But when you take a look at where they're stabilizing, French equities, for instance, valuations are very, very low.
Yeah, exactly. They're very low, and that spread has come in a bit, but it's still very high compared to the past. I don't see them rally from where they are. I think a sign of success for France would be if the equities really rallied and the spread really came in back to levels before the European elections. That's unlikely. I think we'll have a lot of volatility still in these spreads and valuation differences.
Rajeev, let's talk about the euro. I know it's a strong dollar environment. All the global currencies have been under a lot of pressure. When it comes to the euro, I think it's down about 5% this quarter alone. Is there reason for the euro to at least gain some strength from here or not?
Well, there are lots of headwinds to the euro right now. ECB is about to cut rates significantly at its next meeting. The whole path the ECB is moving is at a faster pace of cuts than the Fed. Initially, it was the Fed who looked as though they were cutting fast, but now maybe the Fed's going to cut less. So euro dollar, all of a sudden the direction of interest rate differentials is favoring the dollar, and the absolute level clearly favors the dollar. So that's a big challenge for the euro. Then, we have this political turmoil. We talked about France, but Germany as well, weighing as well. I would say the silver lining is really if something can happen in the Russia-Ukraine war. That would be a positive for Europe, and that would be a positive for the euro. But it can happen overnight. There could be a ceasefire. There could be steps. All those would be the positives I would look for in Europe.
Would you hold gold as a hedge against all these uncertainties very quickly in 20 seconds?
Oh, gold, definitely. And central banks are increasing their gold portion of their reserves because they're worried about, confiscation of their sovereign wealth. And that was the theme of this year, and probably continues.
Okay, Rajeev, hang tight. Rajeev de Mello of GAMA Asset Management is still sticking around. Well, let's take a look at where we are in terms of those Asian benchmarks under some pressure as we await the jobs numbers out of the U.S. It is the final data before the Fed makes its final decision. MSCI Asia Pac Index currently, turning. It is in positive territory, up a tenth of 1%. Still to come, we'll preview the upcoming U.S. jobs report. Keep it here with us. This is Bloomberg. Welcome back. Investors are awaiting crucial U.S. jobs numbers that could shape this month's Fed decision. The data is expected to show a rebound in hiring in November following a month of hurricanes and strikes. Yet the worst might not be over. Avril Hong is here with a closer look. And Avril, of course, this is the final data before the Fed's decision.
Yeah, we still have some inflation numbers to get through as well, but we are laser focused on those non-farm payrolls. 220,000 jobs added to the U.S. That is the median estimate. And the idea that what we saw in October, that near zero print, was because of hurricanes and strikes seen as a temporary one-off factor. So a rebound expected in the labor market. And this would echo the view of Powell earlier in the week about this bullish outlook for the U.S. economy. But Bloomberg Economics is making the point that it would be a flawed assumption to think that the labor market weakness is just because of these one-off factors. They highlight more granular data sets recently, including from household surveys, and they show you how some of these sectors are seeing weak employment, and these are sectors that are not typically heavily affected by Boeing strikes or bad weather. And then you look at the range of projections. There are as many economists that see 180,000 jobs being added as there are that see 270,000 jobs being added. So there's no clear consensus. Flip the board, because it doesn't help that when you look at the jobless claims, it rose to a 1-month high. And there is a lot of noise surrounding the jobs data. To cut through this, MLive's Mark Cranfield suggests focusing on the jobless rate. You may recall that when the July print came out and it ticked up to 4.3%, that was a justification or cited for the Fed's 50 basis point rate cut. Conversely, this time around, if we see it dip to 4% or below, that might be reason enough for the Fed not to cut when it meets the week after next. That is not the base case, though. We still have markets pricing in a 70% chance of a 25 basis point rate cut. Flip the board again. Take a look at what we're seeing in U.S. Treasuries, because if you look across the curve, you may recall that when the Fed was easing mid-September, that they were all below 4%. Look at where it is now. So there's fair bit of pricing back of those aggressive Fed rate cuts. A lot is at stake for the U.S. jobs numbers later today, Has.
Indeed, a lot is at stake. Avril Hong, thank you. Rajeev Mello, Global Macro Portfolio Manager at GAMA Asset Management, still with us. Well, markets pricing in 70% cut for December. You think so?
70% chance of a cut. I think that's a bit too much. But of course, the jobs data is going to be critical. So what we're coming in is an economy which is still relatively strong, inflation which is not collapsing. When we look at the numbers which we're seeing now compared to the economic forecast that the Fed made at September meeting, well, the numbers are higher. So they're more positive both on the growth and on the inflation side. So I think that's why Powell said there's no rush. We're not in a hurry, but if the labor market shows signs of weakness, as everyone mentioned, the Fed's very sensitive to the labor market. If it shows signs of weakness, I think they will cut. So
the clarity for 2025 is not there. In fact, people are wondering what will happen then. I mean, what are you anticipating?
Well, what's going to be difficult is that the Fed's not going to be able to react before it sees the policies voted or announced. Announced in the case of tariffs, until the tariffs are announced, and they wouldn't be before Inauguration Day on the 20th of January, the Fed isn't going to change anything. And then even then, it'll be a bit slow to see where it's going to have an impact, if it's going to boost inflation or not. Likely it's going to boost inflation. The Fed will be a bit cautious in terms of its reaction. That's why I think it'll try to keep some optionality there. And then in terms of that fiscal boost, whether it's tax cuts, that's for the second half. There'll be the discussion. And the Fed is going to be sitting on the sidelines, trying not to be too behind the curve. But at the same time, it wouldn't be rushing to cut, as Chair Powell was quite explicit.
Rajeev, we talk about U.S. exceptionalism. That's expected to persist. But we talked about Trump's tariffs as well. At some point, those tariffs will come back to bite the U.S. economy.
Yes, I mean, especially the kind of tariff plans that he's announcing. We're talking about 60% on Chinese imports from China, and then a global 10%. We've already seen this tweet about 25% against Canada and Mexico. If we take what he's just announced on that tweet last week, that would increase the average tariff rate in the U.S. to some level we haven't seen since the 50s. And that's a big jump, a supply shock for the U.S. and global economy. So indeed, it's going to make things more difficult as well.
All right, hang tight. Now, President-elect Donald Trump has named David Perdue as U.S. ambassador to China. Let's get more on this story from our Chief North Asia correspondent, Stephen Angle. Steve, what are we making of this choice?
Well, he is pro-business, but he's also been on the record of being a bit of a China hawk. He was a late bloomer to politics, coming in as a senator from Georgia in 2015. He served until 2021, then ran for governor of Georgia and lost in 2022. He has a long history in business, serving as CEO of Reebok, of Dollar General Stores, and others. And so he does bring a business acumen to the job, but he's going to be the frontline man of Donald Trump's incoming second administration to manage an often tricky relationship with China. And he follows on the heels, of course, of Nicholas Burns, who served under Biden, who's also had some sharp words about China, especially in relation to the no limits partnership that Beijing has with Russia. So again, he's going to have some very interesting and very tricky dealings with Beijing, of course, incoming if he is in fact confirmed by the Senate. But it's an interesting choice given the fact that Donald Trump seems to be stacking his next administration with China hawks. You have Marco Rubio as the Secretary of State, who will be, if again Perdue is confirmed by the Senate, would be the boss of David Perdue as the ambassador among the State Department hierarchy. Marco Rubio, of course, is well noted as being a China hawk. In fact, he is banned by China from entering the country, which would make it very difficult and prickly if he is actually going to be the Secretary of State. You also have Mike Waltz. He is a representative from Florida. He's going to be the National Security Advisor, a longtime military official who also has been known to be very critical of China. So again, Beijing will probably be watching this appointment very closely of David Perdue.
That's right. As you say, another hardliner, and China looking at it very closely. But China seems to be ready to react. We've already seen tit-for-tat movements.
Yeah, that's right. So he's going to have to be the frontline guy on Donald Trump's proposed tariffs of up to 60%. Plus, of course, because he's added some extra 10% on top of that, regarding the fentanyl issue. So he's gonna have a tough time, of course, because Donald Trump will most likely enter into negotiations, of course, as he did in the first term with that China trade deal, which essentially was scuppered because of the balloon incident, the sky balloon incident over the United States, followed up by, of course, 3+ years, especially in China, of COVID-0. So it'll be a new administration, a new approach, but one that is going to be based on tariffs to limit trade.
Stephen Angle, our Chief North Asia correspondent, thank you so much for that. Rajeev Mello of GAMA Asset Management still with us. I mean, all these China hawks is going to be bad news for China's economy, which is, just trying to recover from the slowdown we've seen for years now.
Yes, definitely difficult for the Chinese economy, which already is suffering from its own domestic collapse in its property market, which is a huge impact on growth for China, a huge negative headwind, and with no real sign of a relief in sight. We have an important conference going on right now or next week in China, and we can hope that there would be some kind of reaction or anticipation. But what we've noticed over the past 2 years of this unfolding crisis is that it's mainly about reaction, and very rarely is the Chinese government really going ahead and saying, okay, we'll do something a bit bigger to stabilize the economy. It's very much about reaction. So now, with all these China hawks in the White House, and probably a huge increase in tariffs, it would really be time for China to try to cushion its economy.
And presumably, China was keeping its powder dry in anticipation of those policies on these Chinese hawks. I mean, if China were to mobilize its stimulus, I mean, what would be enough? What kind of numbers? I mean, what does it need to do?
A lot of comparison is made with the way Japan managed to stabilize and the extent of the fiscal push then, which was about 8% of GDP per year. That would be much larger than what we've heard numbers circulating in China. And the US during the GFC also did some very important fiscal push. China is very adverse to that. They don't want to, they're starting from a very high total debt to GDP level, and they're concerned about using up their resources in a hostile world. So that's perhaps the reason why they're not doing something. But to answer your question, something much bigger.
So China's pain is India's gain. In 20 seconds, India's the place to be?
Well, India's seen some slowdown in its GDP as well. There's some expectations about RBI today, which I don't think they'll move. But in general, I mean, India is a bit of a beneficiary in terms of the manufacturing, but India really has to take advantage of it in a number of different policies as well.
We await the move. Rajeev, thank you very much. So you're not expecting the RBI to move. Rajeev de Mello of GAMA Asset Management, thank you so much for your insights today. Now, still to come, a preview of the RBI's upcoming rate decision. We'll hear differing views from two leading economists next. Keep it here with us. This is Bloomberg. Welcome back. The Reserve Bank of India announces its rate decision later today, with most economists polled by Bloomberg expecting policymakers to stand pat. For more, let's bring in our South Asia economy editor, Ruchi Bhatia in New Delhi. Ruchi, why is the street expecting a hold from the last monetary policy of the year when, you know what, GDP growth was pretty lackluster?
Well, the street is mostly expecting, Haslinda, that the RBI is going to stand pat because inflation is still outside the comfort zone of the RBI. October, we did see inflation accelerating to a 14-month high, and that's probably tilting the balance in favor of a rate hold. Having said that, growth did disappoint quite a bit. There was a 160 basis point miss in terms of the RBI's own estimate for the second quarter growth, with growth coming in at 5.4%, and that is probably leading to, some economists, 7 out of 50 economists that Bloomberg surveyed, saying that perhaps the RBI will go ahead with a rate cut. There's also a lot of clamor with prominent ministers pitching for a rate cut. Having said that, this policy is live for any sort of policy action.
Ruchi, Governor Das's contract expires next week. Can we expect some clarity on the next governor soon?
Well, absolutely, yes, because Governor Das's tenure, 6-year tenure, gets over on the 10th of December, and we're expecting some clarity before that. There is also a possibility that today's press conference at noon will be abuzz with a lot of questions from Das on what's next for him. So far, he's sidestepped any questions on what will be his next moves, but one needs to see what will the government really be doing. Having said that, the Deputy Governor Michael Patra, who's been Das's close confidant, has, his tenure is also coming to an end. We have 3 new external members on the monetary policy who joined in only in October. So there are a lot of moving parts.
A lot of moving parts, and we shall await what happens next. Our South Asia economy editor, Ruchi Bhatia in New Delhi. Let's do a market check for India. A minute into the trading day already, we know that Asian markets have reversed those losses earlier, now in positive territory. Sensex pretty much unchanged as we speak. Like the rest of Asia and the world, we're awaiting to see those data out of the U.S. jobs data, which is crucial when it comes to the Fed's monetary trajectory. Now let's bring in our panel to explain their opposing views on what the RBI will do today. Radhika Rao is a senior economist at DBS Bank. Also joining us, Lavanya, Venkateswaran, ASEAN economist at OCBC. Ladies, good to have you with us. Radhika, you say the RBI will stand pat.
Certainly, I think it's going to be one of those close decisions. You've got actually conflicting. So growth and inflation are diverging now. So the central bank actually was quite bullish on the growth. They did expect growth to come in or stay close to about 6-7%. But what you saw in the latest release is that it's close to 5.4. There could be some revisions down the line, but I think as a starting point, it tells you that the economy would need support. At the same time, you have inflation, which is obviously above, the latest print was above the target. So giving this mix, I would think that the commentary needs to soften first. The governor has been quite, hawkish, relatively hawkish to cautious in light of what's happening globally as well as the rupee, which just like every other currency has been under pressure because of the dollar move. So you kind of conflicting, divergent, in terms of the macro indicators, and that's why we think that while they might take quasi steps to ease, which will be through liquidity on the main repo rate, they will soften their commentary first before they go ahead for a cut.
And of course, Lavanya, you say it's time for a cut. I mean, this is a central bank that has stood pat since February 2023. Everybody has been waiting for that cut, and you say it's finally coming.
Yeah, I think it's more a question of timing rather than if. So it's whether it's February or December. And at this point, I think essentially, the growth numbers have told you that the economy is weak. The incoming activity data is still very mixed. Inflation, yes, on a headline basis is high, but core inflation is relatively flat, also near historical lows, in fact. And if you're looking at the GDP deflator as well, within the GDP print, it actually slowed. Right, growth in the deflator slowed. So overall, there's a sense that, even on the inflation side, the picture is quite mixed. So it's a question of what the RBI decides to filter for itself and which sort of data prints they give more importance to at this point. But it is true that from Governor Das's perspective, it'll be quite a switch. Right, because he's been an inflation hawk. I think even in his previous statement, if you're looking at the minutes of the meeting, he was very clear that they achieved a lot on the inflation front. Growth actually doesn't picture very much in his excerpt per se. So it was all about inflation. I think this time the narrative will definitely shift.
You got to imagine that perhaps the Fed's move would also factor into Das's decision. I mean, this is a Fed that is widely expected to cut in December, Radhika.
Certainly, I think the Fed has already, undertaken 75 basis points of cuts, and this will take it to 1%. So in this light, the emerging markets, if you see Asia in general, has reacted very differently. There were some who were, who saw growth risks and currency risk being managed, and they went ahead to cut rates. In fact, famously, BI and BSP moved before the Fed did. But thereafter, what you've seen in the last 1 month or so is the dynamics have changed a lot. While inflation might be within target, the Asian countries, some of them especially, have chosen to either stand pat or go ahead and cut. BOK more famously recently. For the RBI, certainly what the Fed does is important, but I think in their own policy dashboard, domestic priorities are very important as well. So I think they will take decisions based on that, and hence they have kept rates on hold from Feb of last year. So it's a good year and a half by now. So I think they will continue to weigh that. But at this point, policy needs to be forward-looking. So I think the language, which was really cautious, has to give way to a very strong dovish hint. And accompanied with that, you have the other things that's happening in the domestic financial markets. You've had portfolio outflows. Now foreigners are coming back in, but equity outflows, and which has brought the rupee under pressure. And liquidity is also expected to tighten. So they'll have to manage quite a few developments, and in this mix, I would think keeping rates on hold but starting to release everything else would kind of give you the signal that the markets are looking for.
For you, Lavanya, it is about boosting growth, and we saw how growth has slowed down dramatically. I think it took markets by surprise that it was 5.4% versus the RBI's own 7%. Do you expect the RBI to reassess its growth projections from here?
Yes, I think so. I mean, they're currently at about they're 7% or so, 7.2%. And I think at this point, we are at 6.2% for FY25, which tells you that we are way off from the RBI. And at some point, I think the RBI...
And you're sticking by it.
Yes. At this point, it actually worked out well for us with a Q3 number. But, I think at this point is a question of how the RBI chooses to calibrate. Will it be a big one-time reversal downwards, or is it going to be a step-by-step process where they still wait for the incoming data?
What kind of signaling are you looking out for from Governor Das?
I think a signaling mostly to say that, growth is now a concern, or at least, growth was not as strong as we expected. And so we are going to be looking at what happens on the growth front. Maybe a sense of some indicators that they're probably going to look at, which did not meet their expectations in the third quarter. Because if you're looking at the RBI monetary policy, they suggested that investment spending was actually quite strong. But if you're looking at the GDP print, investment spending was actually not that strong. So, I mean, a little bit of a change in narrative in terms of the drivers, what they suggest with things going forward, particularly on consumption as well. I think all of these will be interesting, especially given that it's going to be changed from last time.
We talked about how inflation remains the issue, and even for the global environment, including the U.S., we are possibly looking at higher for longer because inflation remains sticky. U.S. inflation closer to 3 rather than 2. The same story could apply to India.
Yeah, for India's dynamics are a bit different in the sense that, what you saw in the West, even during the pandemic, was more demand and supply-driven inflation. In India, it was much more supply-driven. I think that's the case still. Oil prices are very benign, so that's not been an issue. But on the food front, which takes up your bulk of your inflation basket, you've actually seen unseasonal rains, play havoc. So certain segments like vegetables, for example, some of the other perishable goods have risen, and then there was an import duty increase which is showing up in some pockets, especially oil seeds. So if you take that out, then there's this big debate whether you should take out food and look at the rest of the basket. And when you look at that, and in fact pressures are benign. We do some trim mean measures to take out the highest and the lowest, and that's at around 4%. You look at inflation expectations, they are still quite anchored. And you look at the business costs, what are expectations on that, that's quite low as well. So that fear about inflation becoming or translating into second derivative pressures have not materialized. So hence our expectation that, inflation now and inflation 6 months from now is going to look different, and hence the need to, soften the narrative.
Okay, so this RBI meeting is about growth, about inflation. It's also about Governor Das's future. I mean, the last time he was, re-elected into that position, we were told 1 month before, and right now we're still waiting for a decision. Do you expect Governor Das's position to be extended, Lavanya?
I think at this point, no news is good news. So we haven't.
What does that mean? An extension?
We haven't heard anything to the contrary right now, right? So I guess the going assumption is that he will be extended. The question is it going to be for a three-year tenure or a 1-year tenure? What kind of extension he's going to get? But that said, you cannot rule out the fact that he cannot. I mean, he's not going to be the governor either. But the candidates in the pool are limited, and so it's. I think a change at this juncture is also a very big step. And there are so many known unknowns coming in for 2025. I think removing the uncertainty around the RBI governor should be something that comes naturally at this point.
Radhika, just very quickly in about 20 seconds, I mean, what would be the biggest challenge for the central bank governor, whether it is DAS or otherwise, for 2025?
I think to manage what's happening globally and what's happening locally, and I think keep an open mind on wanting to provide support, monetary support to the country. Indeed. For sure.
A challenging environment. It is about growth, about inflation. Radhika Rao of DBS Bank and Lavanya Venkateswaran of OCBC. That is it for Inside Horizons. Middle East and Africa is next. Keep it here with us. This is Bloomberg.